今年的上海感觉一发的难，今年好像各行各业都很难做，特别体现在商场行业，感觉今年生意一个月比一个月差。你们看我们超市一眼望去都看不到顾客，我们店有时候一天才卖2000多块钱，除掉成本连我们的工资都不够，不知道我们店还能开多久，感觉再这样下去我们都要失业了。在上海到处可以看到关掉的店铺，好多公司都在裁员，招聘薪资在下降，岗位职责要求越来越严格。今年外卖单子特别少，之前来上海找工作的话，找不到合适的工作，可以暂时先跑外卖，但今年似乎不太理想。同事去年兼职跑外卖，一个月还可以跑2000多，今年一个月几百都难。
The economy is in ruins and most of Shanghai is laying off employees. The economic downturn in China has become an internationally accepted reality, a decline clearly visible, especially in Shanghai, the economic epicentre. This can be observed in several key aspects. The withdrawal of foreign investment in Shanghai, a noticeable absence of foreigners on the streets, a dramatic drop in the prices of luxury and second-hand homes, a series of closures of large shopping malls, bleak business prospects for brick-and-mortar stores, and a significant spike in unemployment, among other indicators. In fact, the deterioration of Shanghai's economy is reflected in the officially released economic data. This year, after experiencing high-speed growth in April and May, the industrial economy in Shanghai saw a considerable decline in June and July compared to the same period last year. Although the economic data for August has yet to be released, the current situation does not look promising. According to the data released by Shanghai Statistics Bureau, the total above designated size industrial output in June was 327 billion yuan, a year-on-year decrease of 11%. The most severe decline was witnessed in enterprises controlled by Hong Kong, Macau, and Taiwan investors, plummeting by 23%, followed by an 18.5% decrease in foreign-controlled enterprises. Small-scale industries experienced the sharpest decline, with a drop of 16.5%. The cumulative total industrial output value for the 6 months of June was 1.9 trillion yuan, an increase of 12%. This cumulative increase was 7 percentage points lower than that of 5 months to May. In July, the total above designated size industrial output value was 326 billion yuan, a year-on-year decrease of 10%. During this month, the largest decrease was in foreign-controlled enterprises, which fell by about 18%, while enterprises controlled by Hong Kong, Macau, and Taiwan investors saw a decline of 14%. Notably, medium-sized industries experienced a significant decrease of 13%, which was 0.5 percentage points more than the small-scale industries. For the 7 months to July, the cumulative total industrial output value was 2.2 trillion yuan, an increase of 7.7%. A cumulative increase that was 4 percentage points lower than that of the 6 months to June. Reviewing the year as a whole, a decrease in industrial output in Shanghai in January was understandable given the recent relaxation of pandemic-related restrictions coupled with the Lunar New Year holiday, which saw many businesses remaining closed. In February and March, the economy saw a recovery with an increase of 9% and 12%, respectively. The surge in April and May was due to a lower base from the same period last year when Shanghai was under lockdown and many industrial enterprises reduced or halted production. The substantial decline in June and July is difficult to explain by other reasons aside from economic recession and worsening conditions, especially considering last year in June and July, not all social restrictions were fully relaxed in many pandemic protection zones in the city. The same situation is reflected in Shanghai's fixed asset investment data. From the chart depicting the growth trend in fixed assets investment from January to July, it is apparent that after a brief recovery in the first 5 months, there was a sharp contraction in June and July, indicating a rapid reversal into a period of significant decline. Examining Shanghai's import and export situation reveals a similar trend. After maintaining high-speed growth in the total amount of import and export goods for the first 5 months, there was a sudden downturn in June and July. The most severe decline was in processing trade, which dropped by 24% in June and expanded to a decline of 36% in July. According to the export market, the sharpest decline was in the US market, where exports decreased by 16% in June and almost doubled to 33% in July. potentially correlating with the strained Sino-US relations and continued efforts by American buyers to move their supply chains out of China. From the data analysis, it is clear that whether considering industrial output, exports, or investments, enterprises from Hong Kong, Macau, Taiwan, and foreign entities are experiencing the most severe decline, aligning with the international trend of continuous withdrawal of foreign capital from China. In recent times, Pegatron Technology, lauded as a mini Foxconn, has been continuously rumored to be relocating from Shanghai to Kunshan, Jiangsu. Established in December 2005, Pegatron Technology in Shanghai is the largest Apple mobile phone contractor. Reportedly, this factory employs up to 80,000 people, boasting an annual output value of about 120 billion yuan, contributing nearly 10% of Shanghai's GDP each year. With the continuous shift of Apple's supply chain to India and Vietnam, China's subcontracting factories that have lost orders are also forced to make corresponding adjustments. Relocation and closure are becoming inevitable. However, due to the massive scale of these subcontracting factories, that there are numerous upstreams and downstream enterprises, even a minor move can have a significant impact on the local economy. The relocation of Pegatron Technology might be one of the reasons for the sharp decline in Shanghai's processing trade exports. Another pillar of Shanghai's manufacturing industry is Semiconductor Manufacturing International Corporation, SMIC, a leading company in China's semiconductor industry. Founded in the year 2000, SMIC is the largest integrated circuit wafer manufacturer in China. In recent years, it has been severely hit by the US imposing strict exports restrictions on semiconductors and cutting-edge manufacturing equipment to China. On August 25th, SMIC released its first half 2023 financial results, showing a double-digit decline in both revenue and net profit. The company reported revenues of approximately $3 billion, a year-on-year decrease of 19%, and net profit of $634 million, down by 34% year-on-year. During the reporting period, the revenue from wafer foundry services was $2.8 billion, a decrease of 21% compared to the same period last year. The wafer sales volume dropped from 3.7 million pieces to the same period last year to 2.7 million pieces this year. The report also highlighted the sanctions imposed on SMIC by the US government. SMIC warned that escalating trade frictions between the US or other countries and China in the future would lead to restrictions on imports and exports and investments, increased tariffs, or other trade barriers. The company might face risks such as strained supply of regulated equipment, raw materials, spare parts, software and service support, and limited financing. This will further adversely affect the company's research, production, operations, and business. This warning seems to be materializing. On August 29th, Huawei, which is still under US sanctions, suddenly launched its new mobile phone, the Mate 60 Pro, equipped with the Kirin 9000S chip manufactured by SMIC using its most advanced 7nm technology. This sparked speculation that SMIC was covertly using US technology to help Huawei. Some US senators have proposed investigating SMIC, which might lead to even more severe sanctions against the company. China's most anticipated large domestic aircraft, the C919, is manufactured by the Shanghai-based Commercial Aircraft Corporation of China, COMAC, promoted by the Chinese Communist Party's media as superior to traditional models like the Boeing 737 and the Airbus A320. It has become a point of pride in Shanghai's manufacturing sector. However, after its first flight from Shanghai to Chengdu on June 29th, it failed to return as scheduled. The widespread doubts about its safety has cast a shadow over its prospects, and its future contribution to Shanghai's manufacturing industry remains to be seen. Now let's turn our attention to another pillar of Shanghai's economy, the real estate market. Recently, the auction of a luxury house in Shanghai attracted many onlookers. The house is located in Huazhou Junting, hailed as the pinnacle of luxury villas in Shanghai. The auction started at 10 a.m. on August 26 and ended at 10 a.m. on August 29th. During the 3-day bidding period, there was silence of 2 days, 23 hours, and 57 minutes. With just 3 minutes left before the closure, a bidder finally broke the silence with a tentative opening bid, marking the beginning of the auction. Following an intense bidding war that lasted 1 hour and 9 minutes, the bidder with number H4101 emerged victorious, securing the villa for a hefty sum of 285 million yuan, around 39 million US dollars, a figure that surpassed the starting price by 29%. However, it is essential to note that the final price is significantly less than the 500 million yuan initially projected by onlooking intermediaries. Not only is this current transaction value less than half the listing price, but it also falls short by about 30 million when compared to the market appraisal of 316 million yuan. Rewind to 2 years ago, a fierce auction took place in the Huazhou Junting community, breaking record on a national scale. Despite only having 2 bidders, the event witnessed 107 bid increments, hiking the starting price of 264 million yuan to a staggering 315 million yuan, an almost 20% surplus, setting a record for the highest price achieved for a single residential property through a court auction in the country. Since May this year, the Shanghai secondary housing market has been witnessing an influx of premium properties listed for sale with increasingly high-profile names, including Lakeville, the Paragon Mansion, and Richgate, among others. These top-tier luxury properties, which were seldom seen in the secondary market before, are now making frequent appearances. Furthermore, the list of discounted luxury homes compiled by the intermediary agencies has grown substantially, now resembling a lengthy spreadsheet featuring numerous high-quality properties experiencing 10 million yuan price drops. This protracted price reduction saga, spanning over 2 months, reached its crescendo with the auction at Huazhou Junting, with properties not just receiving a 10 million yuan markdown or a 20% price slash, but almost halving their original prices. According to reports from intermediary agencies, the month of July saw a 15% decrease in per-unit transaction price compared to June, with less than 100 luxury second-hand homes making sales. Notably, nearly 40% of the properties sold experienced a price drop of over 20%. Analysts comment that the collapse of Shanghai property market resembles a melting ice cream, turning from solid to liquid, from the suburb to the city center, and now even the melted liquid seems to be evaporating at a rapid pace. Both manufacturing and real estate sectors are experiencing a downturn, exacerbated by the ongoing withdrawal of foreign investments. Shanghai, China's financial epicenter where many foreign investment firms have set up their Chinese offices, is notably affected. In recent news, 3 Canadian pension fund companies have decided to pull out of China, namely the Canada Pension Plan Investment Board, CPP Investments, the Caisse d'Épargne Placement du Québec, CDPQ, and the Ontario Teachers Pension Plan, OTPP. These are all companies that ranked first and second in terms of scale in Canada. Insider reveals that this retreat stems from growing frustrations over China's economic trajectory and the strained relations between the Chinese government and the West. On September 7th, Norges Bank Investment Management, overseeing 1.4 trillion in assets, announced the closure of its Shanghai office. Established in November 2007 due to operational considerations, as of the end of 2022, the fund held Chinese assets worth $42 billion, spanning approximately 850 companies and accounting for about 3.6% of its global investment portfolio. According to Bloomberg, amidst the deteriorating geopolitical climate, the decision of the Norwegian Sovereign Wealth Fund reflects a broader shift amongst international investors. Giants like Goldman Sachs and Morgan Stanley have scaled back on their ambitious expansion plans in China. Goldman Sachs recently amended its 5-year forecast and let go of a tenth of its workforce, shrinking its Chinese team that once numbered 600. Vanguard, headquartered in Pennsylvania, USA, entered the Chinese market in 2014, setting up an office in Shanghai in 2017. Initially planning to apply for a public fund license in China and having embarked on a massive recruitment drive, the company abruptly decided to halt the application process in March 2021. It also downsized its Shanghai office by half. Now it seems the firm has resolved to completely exit the Chinese market. On July 5th, Netherlands-based APG, one of the largest global asset management firms, announced that its pension fund clients are increasingly avoiding China due to growing geopolitical risk, accelerating their withdrawal from the nation. In November last year, Moody's shut down its risk management operations in China, laying off approximately 100 staff members. Moreover, Moody's Analytics shuttered its office in Beijing, Shanghai, and Shenzhen in an effort to streamline operations and maintain profitability. Growing concerns among foreign investors are a result of the dichotomy experience of foreign asset management and investment firms in China. Recent regulatory crackdowns, sudden inspections of foreign companies, and worries about China's economic outlook have fueled this unease. In reality, it is not just the examples we mentioned. The entire economic environment in Shanghai has entered a downward phase, with almost every industry experiencing contraction. It wouldn't be an exaggeration to say that a large part of Shanghai is undergoing layoffs. This trend is mirrored in consumer behavior as well. Numerous videos circulating online depict the widespread distress among brick-and-mortar store owners. These businesses are either closing down or barely managing to stay open, unable to cover even their rent cost, much less than turn a profit. As a result, many store owners are forced to abandon their establishments and leave.
The brick-and-mortar retail sector is basically crying out in distress. Initially, you'd see prime shops everywhere holding clearance sales or offering transfers. And when that didn't work, they'd slash prices to rock-bottom levels before abandoning shop altogether. At this point, it doesn't matter if the original investment was in the hundreds of thousands. The only strategy left is to get out fast. And we're bound to see even more closures soon. Everyone says things are getting worse year by year, but this year it's on a whole new level. Previously, even if business was tough, you could still manage to cover the rent and basic living expenses for your family after a month's grind. But this year, it's just too hard. Sometimes, after spending several consecutive days, tending the shop for over 10 hours each day, it feels like we might as well be closed. I'd be content if I didn't have to use my earnings from food delivery to supplement the store's rent. That's the little hope I'm holding on to right now.
Shanghai's economy is a microcosm of China's current situation. Recently, a finance blogger pointed out that China is presently witnessing a grand spectacle where stocks, bonds, foreign exchange, and real estate markets are all plummeting simultaneously, a phenomenon termed as four markets massacre. The slump in the real estate market doesn't need further elaboration. As for the stock market, the Shanghai market briefly surged to 3,219 points, spurred by a temporary halving of the stamp duty policy, only to decline swiftly afterwards. In the bond market, the 10-year national bond futures dropped from 103.1 yuan to 101.6 yuan, while in the foreign exchange market, the offshore yuan exchange rate is plummeting towards 7.36. This uniform downfall in the four markets can only imply one thing: the nation has lost its credibility entirely. Assets priced in yuan are bound to undergo a comprehensive reshuffle and repricing, a process expected to be exceedingly brutal. From an economic perspective, the four markets massacre scenario can only occur when a country experiences a severe economic crisis compounded by a financial crisis coupled with a foreign sovereign credit crisis. To witness all of these crises simultaneously is exceedingly rare, often referred to as a perfect storm of crisis, and is virtually implausible in reality. However, under the leadership of the Chinese Communist Party, spearheaded by Xi Jinping, China has managed to realize this grim phenomenon.